Oh my god, I'm like so liberal and I voted for Obama and Biden and I go to Starbucks and drink my coffee. Whoa.
Loser! Welcome back to Strongman Personal Finance. We're going to cover the earnings of Starbucks, one of my least preferred companies. I would rather get coffee out of a toilet than go to frickin' Starbucks. This place is god awful. It's way too radically left. And it's a coffee shop that is overpriced. They make coffee. You know where I can get coffee? My house, 7-Eleven, Wendy's, McDonald's, the supermarket. There's 100,000 options to buy coffee. And yet you suburban princess brats continue to go to the store with daddy's money or your boyfriend's money. Anyway, let's go ahead and cover this much loved stock because Starbucks stock went down. It's a US stock grow. It is Starbucks. Everybody recognizes it. So, of course, everybody's buying the dip. Oh, and it has a dividend, too. Dividend, brah. It's got a dividend, passive income. So, Q3 consolidated net revenues of 9.1 billion, down 1%. Okay, so the revenues are down 1%. Wow, that's mind blowing right there. Q3 gap of EPS of 0.93. Okay, at least there's a profit there. Action plans partially offset continued headwinds. The headwinds are you're in a no moat business. Q3 active US Starbucks rewards membership totals 33.8. Oh, wow, your rewards members went up. Okay. So let's see some of the sales data. Global comparable store sales declined 3%. Comparable stores are basically like stores that have already existed, to my understanding. Driven by a 5% decline in comparable transactions. So the number of times people are going to Starbucks in the aggregate is down 5%. But they slightly raised prices by 2%, which is less than inflation. Okay, overall, comparable store sales declined 3%. North American comparable store sales declined 2%. So even in America, where everything vertical lines forever, even in North America, comparable store sales declined 2%, driven by a 6% decline in comparable transactions, partially offset by a 3% increase in average ticket. Okay, so funny enough, I don't know how that math adds up, but whatever. Okay, no, this is the US. So US comparable store sales declined 2%, driven by a 6% decline in comparable transactions, offset. So basically, there's less people going, but they've raised prices, but they haven't raised prices enough to keep revenue growing. And how much can they raise prices? This crap's already expensive. It's like $3-4 for a regular cup of coffee. I had one at the airport when I was coming here to Army Hua, and I was like, $4? What a scam for a cup of coffee. The company opened 526 new stores. Yeah, because when your freaking sales are declining and you have no moat, let's just keep opening stores, bro. I mean, I guess that'll drive revenue growth. Ending this period with 39,000. How many freaking Starbucks can we have? 52% company operated and 48% licensed. How much you want to bet the licensed stores make more money? I bet you if they went to like the McDonald's model, they'd probably massively increase their margins, but whatever. At the end of Q3, stores in the US and China comprised 61% of the company's global portfolio, with 16,000 stores in America and 7.3 thousand in China, my you know what, Ina. Okay, so we know revenues dropped, and we know operating margins are dropping as well, okay? Not good. Profits are down, revenues are down. The only bright spot is rewards loyalty program. Yeah. Okay, I'm sure that's going to save Starbucks. So, they give a little bit more data here, but overall, look at the revenues of the US. So 6.8. This is the US, right? North America. So that includes the US, probably includes Canada too. So 6.8 billion of revenues in North America on 1.4 billion of operating income for a 21% margin. Then we go internationally, 1.8 billion of revenue on 287 million of operating margin, 15.6. 15.6. Margins are way lower. The highest margin thing they have is this channel development segment where they sell like branded coffee and SKUs and stuff. But it's such an insignificant amount that it really doesn't change anything. And if you look at the revenues, they're flat. Okay? The only reason they were able to increase operating income was because they cut expenses. Okay, their revenue for their most profitable segment, channel development, is down 2%. Internationally, it's down 7%. And then in the United States, okay, or North America, we got a 1% overall revenue growth in the United States. Okay, this is an absolute disaster. So let's see. I thought they talked about. Okay, so here's their company update. Let's notice the first thing they mention. So it's like, hey, oh, your revenues are declining, your margins are declining, you're sucking internationally, even in North America and the U.S. You're not doing that well. What's the first thing you're going to tell us about your company update? In May, the company announced new commitments to further LGBTQIT partners and communities, including an expanded partnership with the National Center for Transgender Equality, providing transgender, non-binary, and gender non-conforming partners support for name and gender marker changes. This is the first thing that they list on their company update. Because that's the most important thing. Okay? Your stupid coffee store. This is the most important thing that they talk about in their company update. What do we have next? Pure degeneracy. What do we have here? Satya Nadella resigned from the company's board. Okay, I guess more. Actually, no, that's not more important than the first bullet. Okay, what about this? Partnership with Grubhub. Oh, that's not important. Okay. Starbucks delivery is only expected to approach $1 billion of revenue in the U.S. Who cares about that? Starbucks Studios, they're producing original entertainment. Yeah, you need to produce entertainment. Oh, I can't, I'm sure the entertainment's going to come from this. That's going to be their entertainment. They're going to produce original entertainment and amplify stories. Wow. I wonder what stories are going to cover as well. Let me guess. Do you think people that look like me are going to be covered by Starbucks? No, we're scum. In June, the company launched loyalty partnerships with Marriott. Okay, wow, who cares about that? And, least important, the board of directors declared a cash dividend, returning capital to the investor, of 0.57 per share. Who cares about that? What's more important is this, getting the kloop and the boom boom. Okay, so let's go look at let's just look at everything here, okay? Company-owned store revenues down. Licensed stores revenues are down. Other is down. This is their stupid branded drinks and in Food Lion that are too expensive. Okay, well, they cut product and distribution costs. They had an increase in store operating expenses. So operating expenses are going up, probably because of wages and the flags they hang. Both the rainbow flags are hanging. So that goes up. Other operating expenses up. Depreciation and amortization. So it looks like they're buying a bunch of property, plant, and equipment. That went up 11%. So sales are declining, and of course expenses are going up in a vertical line. That's wonderful, okay? Especially the store operating expenses, which are the biggest expense they have. We have income from equity investees. So this is like businesses they have partial ownership in, and the profits of those underlying businesses are reflected in the companies that own them. So whatever they're invested in, Starbucks records a portion of their profits on their income statement. For total operating income, down 4.2%. Wow. Okay. Let's see. Interest expense is flat. Interest income's up a little bit, but that's immaterial. Let's see. Blah, 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 blah. Okay. So we know EPS is down. Like this is just not good. Okay. International, everything's down. Oh my God. Woo. They're getting crushed. But you know what? This coffee store is 100% going to come from the debt. All right, let's look at their balance sheet. So June 30th, 2024, $3.1 billion of cash, $212 million of short-term investments, $1.1 billion of accounts receivable. So their liquid assets, liquid current assets, are roughly what, 4.5 billion, something like that. Am I doing my math right? It's late. 4.5 billion. Their current debts are 7.6 billion. Let's see what these are. Accounts payable, accrued liabilities. Current portion of operating lease life. So this is lease payments due within a year. Store value card liability. Okay, so this is like gift cards that have already been purchased but haven't been redeemed yet at the stores. So their current ratio, isn't too hot. I mean, I'm sure they have plenty of access to credit facilities and they'll be able to pay their short-term debts, but not the best current or quick ratio to measure their ability to pay short-term debts. Let's look at their long-term assets. Okay, long-term investments, equity investments. This is the companies they own. You can see it increased because when the underlying company records a profit, you increase it on your balance sheet. PP&E, they're throwing money into property, plant, and equipment. They're opening more stores. You can see the leases are going up. Let's see, deferred income taxes. This is tax savings they think they're going to get in the future, but that's based on judgment. Let's see. Man, look at that. $3.1 billion of goodwill from acquisitions. So overall, their long-term assets are roughly $24 billion, and their long-term debt is, what is that, $29 billion. They have an accumulated deficit. They have more debt than assets. Wow. Retained deficit. I wonder what that's from. They're probably freaking buying. Either they're recording huge losses, which I doubt, or they're buying and retiring back a bunch of stock. Okay, that's what I suspect they're doing here. But you know what? Your revenue's dropping, everything's dropping. Let's keep buying back stock. Well, why don't we do that? Okay. Okay, cash flows. They have healthy cash flows from operations. Nothing crazy there. I don't see any massive red flags. Okay, let's see investing activities. What are they doing? Man, they're really chunking money into opening new stores, man. They're desperate for that extra revenue. All right, let's look at financing activities. This is raising money through debt issuance or stock issuance or buying back stock or paying off debt or paying dividends. Dividends go down here in financing activities. All right, so let's see. Issuing long-term debt. Got it. So they issued, let's see, almost $2 billion of long-term debt, and they purchased roughly $2 billion of PP&E. Okay. Let's see. Not really crazy. Common stock. They increased their dividend. That's good, I guess. And they bought back stock. So they spent $3.2 billion buying back stock. So they made 4.5 of operating cash flow, and they bought almost $2 billion of property, plant, and equipment. So that leaves $2.5 billion of cash to pay dividends. So they paid out more in dividends and stock buybacks than they made in free cash flow in the last 3 quarters. Okay? I'm sure that's sustainable. It's such a stupid business. I hate Starbucks so much. So obviously, I don't know why did the stock go up. Let me guess. The stock vertical lined after this. Of course, it's up 3.67% because, I don't know, did they beat something? Is their dividend yield going up? Is that why Wall Street's buying? I don't freaking know, okay? This is a freaking turd. Stay away from this. Have a wonderful day. If you like this video, don't forget to hit like and subscribe. And if you want a sponsored video, or you want private tutoring, or you want to buy my book, check out the pinned comment below. I'm sure you'll find value in those. Or, you can spend your money on Jeremy LaFave. Anyway, talk to you later. Cheers!